Hello people, it has been a hot minute since I've made a video. It's been about a year since I properly made one and kept it on the channel. So in this video I want to explain to you how my trading has evolved in the last year and why that should matter to you. Because I left this channel for a reason, and I can honestly say that now I've never been more confident in my trading ability than ever before. And so if you have 5-10 minutes and you're interested in how things have evolved, how it may or may not be relevant to you, then this is probably going to be a video that you like, I hope. But if not, then I'm sorry. So for those of you that do not know, I was a technical trader for most of my trading career, so technical only. So I started trading in about 2018. Technically it was 2017, so I'll just put 2017/18. This was fine. I went through all of the normal kind of issues that people go in. I started off, did terribly, eventually kind of had this long drawn out rock bottom phase, and then kind of saw some glimpses, kept getting smashed down, and then eventually kind of started on the upward trajectory. That being said, there were always things that I didn't like about trading, and maybe these are things that you can relate to. So for example, common things that technical only traders find a lot of the time. Back tests go well, live fails. How many times have you back tested something and been like, oh my god, this works really well? You move over to live trading and it's like, oh my god, this doesn't work well at all. Super common. So we'll circle back round to why these things are in a minute, or some of the reasons why they are. Another situation is you have complete lack of conviction, meaning the confidence in why you took a trade doesn't really exist. The only conviction, the only confidence you can have in what you did is basically if you have some back tests and you can look at those back tests and be like, okay, look, I know that the numbers should play out. But then if that was the case, and once you've been doing this for a while, you'll realize, you'll look back at your back tests and you'll be like, oh, well, the back tests are my confidence. But then when you go in the live markets and it's not performing as well as your back tests did, then your confidence in the back tests disappears. And you've got no reason. You're essentially putting all your faith in one spreadsheet that was basically going over a very specific set of rules in a very specific time period that may be completely different to the current time period. And I'm kind of jumping ahead of myself a little bit here, but essentially you're putting your conviction in a line drawn on a chart. Now, am I saying that there's no value in them? No, in fact, I'm going to explain to you in the video, right, the benefit of technical analysis, but also why most people get it completely wrong. And I'll give you in fact, fuck it, let's just talk about that now. So here's the big thing with technical analysis, right? Everyone thinks that technical analysis, the value of it is technicals can predict price some of the time. They don't think it predicts price all the time. You know, you'll get people that are fairly rational and they're like, yeah, but it can predict it some of the time. But they think that because of this belief, this is the same thing that causes traders to do one of the following, pretty much just this in different ways, which is they study patterns. Now, to be clear here, and I want to make this absolutely clear, I don't care if you trade SMC or you trade a version of SMC or some wanky weird little line on a chart or a box or you know, XYZ 360 no scope strategy, you know, or blah 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 strategy. Doesn't actually matter. All of these, if they are just based on technicals, are just different versions of the same thing. I don't care if you use moving averages or you look at market structure to read a trend. You are still just using technical analysis. That's it. Now, why is this important to understand? Because what happens with most people is when they do, okay, let me just write this out here. Right, so here's what happens with most people. They'll find something normally on YouTube. They'll be like, oh, cool, man, this looks pretty cool. Really liking this. They'll start trading it, or they'll back test it if they're a little bit more sensible. They'll be like, okay, got this to work now. Happy days. Happy. They'll go and execute it. Eventually, they'll hit a streak of losses. They'll reevaluate, and they'll go back to YouTube. This is the kind of deathly cycle that unfortunately most traders find themselves in. I was in this cycle for a very, very, very long time. And it's understandable because technical analysis is sold to you by brokers. It's sold to you by people who either don't know any better or are ignorant to it, or who know it and are deliberately trying to mislead you either for their own benefit or for something else. And they are making you believe that it's something that it's not. technical analysis doesn't predict price. Now, does this mean that it can't have predictive elements? No. But it's very important to understand the difference and understand exactly what it is that we're trying to get out of technical analysis. So I'm going to write down 4 phrases here. So these are market properties that technicals can exploit. I'm going to explain why these are different to the way that most people look at things, and why that's important. So I'm going to just list them all out first, and then I'll go back over them and explain what each one is. So the first one is autocorrelation. The second one is mean reversion in volatility. The third one is liquidity clustering. Now, before all of the SMC guys start creaming their pants and going, oh my god, liquidity, he said liquidity, therefore blah blah blah. Liquidity is not really the same as all the smart money guys seem to be obsessed that it is. Feel free to argue with me in the comments, I don't care. Final one is path dependence slash reflexivity. All quite complicated sounding names. So let's break each one of these down. First one, autocorrelation. What in living hell does autocorrelation mean, you might be asking? Good question. Autocorrelation is just a really fancy term. Just write this out again. For the idea that short-term continuation is more likely than not, more so, I've really worded this badly, let's just leave it at that, is more likely than not. This is a element of the market that has been proven. Now notice why have I specified this? It seems so obvious. It's like, yeah, well, doesn't that mean like my trend line works? It's like, if you're obsessed with the tool, you're going to miss the reason why that tool works. And then when the tool stops working, you'll look for another tool instead of understanding the fundamental thing that makes up the market. See what I'm saying? So I'm going to give you an example. If you are trading trend lines and you find that that can work for you, it's not working because of the trend line. It's working because of a market characteristic that the trend line is taking advantage of. That means that whether you use the trend line, a smart money, magic box, or this or that or whatever, or other fancy tools some influencer has packaged up in neat little bow ties that they can sell it to you, you're actually capitalizing on a characteristic of the market, not the random set of lines, boxes, circles, text marks, blah, blah, blah that you pop on a chart. Super important to understand this, because then when something goes wrong, you realize, oh, I'm not looking for that thing that I thought I was looking for. I'm not looking for the brand new technical tool. I'm not looking for this. I'm not looking for that. I'm looking for something much more systemic. So why does this create, opportunity for, technical traders? Well, it's obvious. It's like momentum continues and ranges continue, meaning if price has been doing this recently, chances are it's going to keep doing some version of this in the near future. Now, of course, you may catch it at the wrong time and it suddenly breaks out, but then you've still got this new information. You're like, okay, well, this is more likely to continue than not. Now, I still wasn't satisfied even with this, even though this is absolutely fine for an edge. I wasn't satisfied with this personally, which is what I'll get to towards the end of this video, and I'll explain how I fixed that problem and how I'm looking at things now. But these things are still important if you want to be technical only. They're still important. I have made a Telegram group where I'm going to be, from now on, just kind of sharing my thought process, sharing what I'm doing completely for free. You can join that, and so hopefully that will be of interest to you. I'll leave the link in the description box below. So the next one, which is kind of similar. So the next one is mean reversion in volatility. So it's the idea, and by the way, these are all things you can research. They have been proven academically. Academic research is not always super relevant to traders because of the way they test it, but some characteristics of the market are really important to know. So this is basically the idea that volatility clusters, then contracts. Very similar to the first point. It's basically saying that range systems work because the order book, stress dissipates cyclically. So again, this is quite a complex way of writing it, but basically this is a fancy way of saying that because of how the order book is structured and how it works, in other words, the transactions of traders, ranges work because of basically those mechanics there. You can research this. If that was a shit explanation for me, but you're more than welcome to research this if you want, or I'm more than happy to make a video in more detail if you would like as well. So next one, liquidity clustering. So SMC guys, get ready to, I don't know, hit me. So liquidity clustering. What does this mean? Orders congregate at visible reference points. Yes, now this sounds like SMC. It's like, oh cool, well, liquidity's at these equal highs or these equal lows or this really fucking obvious weekly high. It's like, yeah, but not because it's magic, just because if you think about it, it's just logical for human beings to put it there. But it also doesn't mean that things suddenly have to be taken up and things have to then move in the other direction. It needs to react. It just means that we know that there's going to be activity happening at that place. And of course, you can look at price, you can confirm it. I'm not saying that these things can't exist. I'm just saying a lot of the existing theories about price that seem to be circulating on the internet these days are pretty fucking hilarious. Anyway, so this is the same reason, right? And another reason why I wanted to specify this from SMC. This is the same reason why you could say that support and resistance works. Works in brackets or quotations here, because you're basically just working off where orders are sitting. Doesn't matter whether you draw it really refined and you spent 3 years mastering a kind of magic drawing of a level, or you just mark out a rough zone. Same shit. Like, it's just the same shit. Like, if you try and argue with me, good luck. I would love to have an argument with someone. If anyone wants to come on these channels and just fucking argue with me for 10 minutes, 20 minutes, an hour, let's do it, man. I love it. And by the way, this is not me insulting anyone who believes this stuff. I've just been doing this a long time and I've studied so much that I just have specific opinions, but I'm always open to change them. But this is kind of where my head's at after a long time doing this. Okay, so final one. Oh, but actually, before we do that, in fact, no, I've kind of covered that. So I'm just going to call this next one reflexivity. This has a lot of meanings, especially, you know, if you look at kind of the George Soros definition. This is the idea that price action itself influences price. So if you think about it like, if we have a company that is really, really high quality and kind of similar to the Warren Buffett example, I think that was in this video, I can't even remember now. If you believe a company is going to go from here to here, if the markets were completely rational and unemotional, it would probably look a lot more like this. If there wasn't new information and all these people with different agendas pushing price all over the place. But these kind of gyrations we get in between on its journey to and from a certain target, these are not completely but largely driven by emotions. Even algorithms are subject to emotions for the most part because they're coded by people and people are designed to capitalize on the market and the market's run by people. So let me explain what I mean. The fundamentals throughout this period are represented with this line here, which I'll make white. So why would we gyrate so much around this? Well, because people tend to overreact and underreact to certain pieces of information. George Soros, I believe, is the one that coined this idea, as the idea of reflexivity. Meaning what tends to happen is when new information comes out, price tends to, let's just say, rise in this case, gets more media attention, more and more people start talking about it, prices go up, people start feeling more comfortable about it, they start thinking it's a trend, which means more people buy it, which means because it's going up more, it gets even more media attention, which means even more people buy it, and it reaches this point of like, oh my god, oh my god, oh my god, oh my god, until the point when the market suddenly realizes, we've kind of been overreacting to this isn't as crazy as we thought it was going to be, and then prices kind of move back to essentially equilibrium or true value. This is a really important thing, and this is so important because this is another reason why momentum can continue. And you'll find that a lot of these things are all kind of, in terms of the effect they have on price, are all very similar to one another. Maybe you're finding some similarities with the current system that you're looking at it, or the way that you look at the market, whatever, okay? These things are really what makes technicals work, but it's not the important thing of like, oh, which system do I pick, or like which like technical like adjustment, or oh, I trade the XYZ system, oh, I trade the liquidity, blah blah blah. So, like, if you're thinking like that, like I'm just going to tell you right now, you are missing the mark of what's going on. Doesn't mean that you can't technically make that work, but I just don't think it's the best mindset, because it frames you for failure when something does go wrong, because you don't really understand the core mechanics of what's going on. Now, this is just a very basic overview. Like, this is like embarrassingly basic in terms of like how deep that topic can go. But I want to go back to the idea of why I decided to not only trade this way, and how I've managed to kind of blend things together. And I'm going to be talking a little bit about fundamentals. So just to be clear, you will notice if you've been in trading for a while, the best traders ever have something in common, which is when you make money, so for you to win, someone else has to lose. This is a key thing about trading. This is the same reason why it's often contrarians in some way. That doesn't mean you have to be selling when everyone's buying. It just means that you are going against either the short or long-term consensus about what a stock or an asset or FX or whatever is going to do over a specific time horizon. That's basically it. Now, the thing is that if you're looking at price equals the outcome of the past, right? Meaning, if you're looking at current price, that is the outcome of all the information that's currently out right now, and all the information that has been out. And so if you're only looking at that, if you are going, for example, and this comes to the heart of it, right? Let's just say you trade a range system. So you do really well when prices do this sort of thing, right? You're doing really, really well. One day, we have a huge breakout to the upside. Your system has no clue, because it's just based on technicals, if this has any likelihood of continuing. You may look at the essence of price and use one of these things down here, which you may already be thinking of. In this case, autocorrelation. Short-term continuation is more likely than not. And by the way, continuation doesn't mean trend. It's talking about the volatility and like the directional regime. So whether that's up, down, it's more so about how price moves rather than where it moves. So if I see this big move here, I'm not thinking, oh my fuck, this needs to be an uptrend. I'm thinking, okay, we've moved into a directional regime. We could have moved into it. But the problem is you've got no confirmation at all. You've got no way of actually knowing other than what price has shown you. This could be an overreaction, and we could dip straight back down. This really frustrated me after enough years of doing this. And so eventually I was like, okay, how can I, or is it even possible to get better at understanding what the role of things is here? Now, when I first got into fundamentals, I had the belief in my head of like, oh, the job of fundamentals is to predict this before it happens. And it can be that, absolutely. But it depends how you want to use things. For most of you who are looking at things through the lens of a kind of very short-term trader, then the way that fundamentals are going to be useful are probably not in the same way. The way I would do it, in terms of a short-term approach, like when I'm just doing intra-week stuff, like holding things for anything from like 1 day to maybe like 2 weeks or something like that. In that scenario, I find it's best to wait for price to tell you something's happened. For example, this has happened. Then I do the background analysis of, okay, why has this happened? What were we doing before this range? Does that tell us, like, what's the story been around here? And what are the key dynamics I need to pay attention to? Now, this is obviously a massive topic. I'm not going to go into detail about exactly all the details of how to do this. I'm more than happy to discuss it more, but it's something that is a topic for another video. But let's just say you've come to the conclusion of, okay, now I know why this is happening. Has this got enough juice to continue going? And it's not about predicting every time, as always. It's just about tilting the scale in your favor a little bit more than random chance. And so if you know what you're doing, you can look at this and go, okay, I think this has got a pretty good chance of continuing. And then you just flip your bias. But most people think that that's it. Because even if I looked at price and I just assumed things were going to continue, I could have seen that. But the benefit is not just knowing, it's because you know, it's about how you change the position sizing. Because if you have confidence, it means that you're waiting of like, okay, how much do I position size here versus in here? That can change slightly. Changes how likely you are to hold winners to hold on to your winners, or scale in, or trail your stop. Whereas if you know you're more likely to be in this kind of an environment, you're more likely to kind of keep your winners relatively short, keep your stops pretty like relatively tight, just basically be in and out, in and out, in and out. And then as soon as that changes, if you have that confirmation, that is the thing that can be like, oh, now I know that I'm more likely to be in this environment, so I'm more willing to hold on to winners or whatever. Whereas if I looked at this and was like, I don't think this has got any weight whatsoever, I was like, I think we're going to go back into a range, or we're going to come back down. That's going to influence massively the type of approach that I take. And so this is an example of what I would call price first, story second. So second to confirm. So the idea is that you see price, then you look at the story, and the story isn't just looking at, oh, why did this last candle go up? That's not good enough. It needs to be an understanding of all the mechanics going on behind the scenes. Now, you might be wondering what those are. Okay, that it's, like I said, it's a complicated topic that I don't really want to go into right now. I'm more than happy to do it. If you just want to see me doing this day in, day out, then just join the Telegram. And that's where, at the time recording this, I'm just going to be kind of fucking around in there, sharing what I'm doing, and hopefully you like that. And so this is the kind of premise of what I've been doing. I've been moving into this. And now beyond just that, what have I been doing? I've been trying to understand, okay, well, is it just FX that I want to be trading? And really, I've realized that there are a couple of different types of traders, and it really just depends which one you want to be. For me, I really like knowing why things have happened. Doesn't mean you're going to know every single time, but especially when you're just looking backwards, you can tell why something's happened, and that's going to influence how new information comes out. I personally don't really trade intraday anymore at all. And by intraday, I mean where I get in the day and like I'm out within a few hours. I just don't do that. Like the 4 hour is my entry time frame. It's the lowest entry time frame I'll do. Sometimes I'll just keep it on the daily, and that's it. For me, that's fine. I also will be open to multiple markets now. So I'll be open to stocks, I'll be open to whatever, because I've realized one key thing, especially if you are a directional trader, meaning you are looking to take advantage of direction, then being able to see which market is most likely to move directionally, that's going to be key information. And so why is this important? Well, because fundamentals tell you a few things that are relevant that price does not. First one, which markets have the best likelihood of moving? One of the problems technical traders face over and over is they are victim normally to 1, 2, 3 FX pairs or whatever they've narrowed themselves into trading. They'll be like, oh, I'm just trading this. And so it's very easy to overtrade there because you're always waiting for something on that specific pair or that specific asset. Whereas you don't know if that's even going to be the ideal thing. You don't know if that's going to be the ideal asset at that point in time. And so fundamentals are great at this because it allows you to see, oh, okay, I think that like the US stock market is better primed to do this, or this sector of companies is really likely to do well in this next period or this next time period. Versus, oh no, I think that USD JPY has the best odds of doing this. You can't do that with technicals. I don't care how good you think you are. It just doesn't happen. Now, fundamentals aren't magic, and it always seems like, oh, I have to spend all my time reading the news. You don't, because there are proxies that represent it. Again, I'm more than happy to discuss that, but if you just want to see me doing it, just join the Telegram. So, which markets have the best likelihood of moving? The next thing we've already kind of touched on, which is, does this move have any weight behind it? So, you can look at a move as we did here and go, is this strong enough for me to make a serious decision about what's good or what's bad? Simple decision. Now, this isn't to say, like, to be honest, these are the main two things that I find are most helpful about fundamentals. They're not like insane. It's not like a crazy shift. Everyone thinks, oh, I switched to fundamentals and just everything became easy. It's about being better at spotting where the outsized opportunity is. And often it's not even about predicting. At least for me, I just like to look at what price does, at least in FX. I look at what price does and then I go, okay, let me understand the story of this pair, what's going on. If we're in a position where I think the same sort of behavior from the past is going to keep happening or not. And a lot of the times, especially in FX, because of how fundamentals work, you're typically looking at like a 1 to 3 months time horizon. Now, it's very important to separate the fact that I'm looking at that as a time horizon. That doesn't mean that as an active trader, you couldn't trade in between that, right? Be in and out, scale in, scale out, do all these sorts of things. But this is just about fundamentals. Like if you're looking at it like in and out each week, like looking at it going, oh my God, the inflation came out, which means this, which means that, it's too much noise, okay? You need to be zooming out and really understanding what's going on, which can cause confusion. So I wanted to come over to a kind of clean example of these sorts of behaviors in action and how they play out and all these sorts of things. So Euro USD on the weekly time frame, this is a very, very nice example of how these regimes typically play out. So without knowing anything else though, before we get into that sort of stuff, I just want to explain what I was talking about with the technical only approach. The methods of autocorrelation, liquidity clustering, volatility clustering, these sorts of concepts are all visible here. It's the idea that when a certain characteristic of price plays out, it's more likely that will continue to play out. Even if you didn't realize that this was a downtrend until down here, you still had this period down here where you would have been right predicting a downtrend. Or even if you here didn't have a massive target, got involved there, you could even argue that until here you would have been absolutely fine. Eventually, let's just say you got stopped out from here, from a sell here or whatever, that's fine. But at that point, it's like, okay, this is a very big candle. Even if you knew nothing fundamentally and you're just like, look, I just reckoned that recent price is going to continue in the direction that it is, and you just started trend trading this all the way up here, kind of let your winners run a little bit more because you thought that the momentum was there, trailed your stops, maybe scaled in a little bit, and then when that stopped working and the market shifted back down to showing evidence of being in a sideways market and you just adapted there, that is a form of environment selection. If you guys have seen my previous videos, I always spoke about environment selection. What I just described is the technical version of environment selection. And there's nothing wrong with it because it is grounded in certain principles. But me, being greedy, wanted a little bit better than that. And so for me, I wanted something fundamental. I wanted to understand what was going on. And whilst it may at first seem that it's like, okay, I need to be some sort of like wizard with the charts, I need to understand all of the numbers and watch every news announcement and all this sort of stuff, a lot of the time it is not that whatsoever. And so let's go through the same scenario, and I'm not going to bore you with a load of fundamental stuff that you may or may not care about. I'm more than happy to make videos specifically about that, but I don't want to bore you if that's not you. The kind of long and short of it here is they thought that the European Central Bank, the ECB, was going to cut rates before the US, amongst a few other things. Obviously, it's a little bit more complicated than that, but just as a general idea, you can see that clearly if we were to plot out the yield curves here and stuff like that. Anyway, so because we knew that, because we employ, remember what I said before, which is price first, story second. After we saw this movement down here, breaking some structure, most technical traders are going, okay, well, the system still says this, or maybe it does already say a downtrend or whatever, but I haven't got any conviction, so I'm just going to kind of pray and just rely on pure risk management and stuff like that. That's fine. But if you knew the story and you knew, okay, like this story has some real legs now, I think it's more likely than not that this is going to continue, at least for the near future. Doesn't mean you have to predict, it's going to go here or whatever. You just think it's slightly more likely. That means that because you knew that, you'd be willing to risk maybe a tad more, or scale in a little bit more aggressively, or trail your stop more aggressively, or let your winners run slightly more. Those things sound so small, they sound so obvious, but those tiny little tweaks can be the difference between a non-working strategy and a fucking insane strategy. And so those tiny tweaks, it's not about, can I predict price more? It's about just can I tilt the probability a little bit more? And when they are slightly more in my favor, I know they're in my favor, rather than with a technical system where it's like, I hope they're more in my favor, and then tilt it and then slightly lean into those scenarios a little bit more. Doesn't mean you can't trade all the scenarios, but hopefully you see the point there. Then things kind of do their thing, they come down, and then we enter the typical kind of transition phase, and then a new catalyst comes out, and then with that, we're like, okay, does this have serious weight? And then really all we're doing with the fundamental stuff is like, okay, does this story have any legs? And can we have any conviction? If you've got more conviction, it means that I'm going to be more willing to press this because I'm like, okay, this is more likely to be a strong trending environment. Therefore, I'm going to press it. I'm going to press it. Doesn't mean we're reckless or we over leverage or any of this stuff. It just means we're more willing to hold winners a little bit longer, scale in, trail stops, all this sort of stuff. And then when we see price, again, price first, starting to consolidate, it means one thing normally. Let me just change the size of this a little bit before I write it out. Let's do 20. It means the story that caused the big move has been absorbed. This is so important to understand, because if you understand that that story has been absorbed, it's going to change everything. It changes what metrics the market really cares about in the economic calendar. It changes what the fear is. The markets aren't always just basing their movements just off pure economic calendar. It's about the story that those create. Inflation metrics could cause massive, massive uncertainty and huge price moves in one particular phase, but then 2 years later they could barely move price. And it's because things rotate. And there are 4 main regimes that price goes through, but I'm not going to go into that in this video. But it's surprisingly predictable. What isn't predictable is when it's going to happen, and the reason for that is why I always go with price first, story second. Because if you try and go with the story first, you're going to run into loads of times where you're wrong. It's going to be overwhelming, all these sorts of things. But the difference really is all just about knowing when to press, knowing when to just stay stable, knowing how to manage your positions. Most technical only systems will just say, yeah, I just manage my technical system. I just do the best that I can, and that's it. Like, I just follow the rules and that's it. But the adaptability, the environment selection, that's the thing that allows you to know, okay, is it time to do this or is it time to do that? What's the best move? Where are the odds slightly in my favor? And so my journey into fundamentals has really just been that. It's just been about when are the odds slightly more in my favor. It's just been trying to get a better edge than I had before. Now, also notice that the time horizons of this, right? So this was about from the end of Feb 2025 to about the end of July. So what's that? About 5 months. Whereas over here, it was from basically mid-September to December. So that's what, three months-ish. So in that case, each regime doesn't have to last the same amount of time. It doesn't have to move the same amount of time. But it's really important to be aware of just the fact that there is a new regime. You might have noticed up on the top, this tab here is a regime detection model, which is something that I have built to help spot this and to help understand what is going on in the market, what the perceptions are, without needing to look at the news headlines, because that doesn't particularly interest me, and there's so much noise there. And I think that's a big thing, right? When people think fundamental, they think, oh my God, I've got to sit down and watch the news and have like a million things together. It's like, no, the markets are pretty efficient. So if you just look at the relationships between other markets and specific ones looking for specific things, you'll be able to read what the participants think pretty quickly. And because we're doing price first, we don't need to predict. It's about understanding, does what's happening right now have legs? Does it have weight? And if you've already got momentum on your side, then kind of half the job's already done. The last bit is just for that extra nugget. If you want to really push it, understand what that next thing is. And that may not be in the FX markets. Like right now, if you're just trading direction, and you're a trend trader, Euro USD is going to be shit for you on this time frame. Yeah, you could be like, yeah, on the 4 hour it might be fine, or 1 hour, whatever. But even so, it's not going to be like the big move that a lot of people would like. And you're not going to have the same conviction. Whereas right now, during this period, money, you've got to understand, money is always rotating in things and out of things. And right now, the money is rotating out of Euro USD. That's a massive simplification, but just it's an easy mental model to look at it like that, right? So the question is where's it gone? And if you're just looking at one market and trying to understand it, whilst I believe that's a great place to start and to go with things, if you really want to understand what's going on, get the best opportunities, you could be like, okay, cool, I know that this money is left here because of this. Where's it going next? Where's that next big fear? What's the next big catalyst that's going to push price in this other direction? Can I map that out? That for me is super interesting now, because I actually feel like my skill is being rewarded directly. Whereas with technicals, I would get rewarded, but then I still wouldn't understand what was going on. And when I got punished, it was like, I didn't really get it. I just didn't understand why. That for me was something I didn't want to do anymore. That being said, still a huge part of what I do is technical, especially in FX markets. It's a little different with stocks and stuff like that. But if you'd like to see me doing this, at the time of recording this, I'm just going to start sharing things in the free Telegram and sharing my thoughts and outlooks. And if you're interested in that, then let me know. I'll leave the link in the description box below. You can also message me directly if you're interested. But yeah, I hope you have enjoyed this, and let me know what you think. Because if you hate this sort of stuff, I'm not going to keep making these videos for you. And you know, wasting your time and wasting my time. Like, just be honest. I don't mind. Just let me know. But guys, if you have made it this far, I really, really appreciate it. And yeah, hopefully see you very soon.